Good afternoon. Welcome to our third Thursday at 3. I'm Doug Twiddy, Director of Annuities and Partner with E4. Joined today with me is Daniel Cambron, our Case Design Specialist. A few housekeeping things. Webinar is set up so that everyone can interact with each other using their cameras and audio. Everyone can start by staying on mute like I just was. Up to you whether you want to have your camera on or not. If you want to ask a question, please use the hand raise or reaction button at the top toolbar, come off of mute, or put your question in the chat box. Today's third Thursday at 3 will be recorded and posted to our Marketing Central in the advisor portal of our E4 website and on our E4 YouTube page. Today's topic is how to properly structure a tax-free retirement. Most retirees are sitting on a future tax bomb, as we know. Today, we'll unpack some ideas on how to reposition qualified assets during the retirement tax valley using Roth conversions and annuity strategies, turning forced taxable income into tax-free income for life while reducing future RMDs and taxable Social Security. So, Daniel.
Hi, how are you today?
I'm doing good now that I'm off mute. So, you know, I think part of the complexity of this whole conversation is how many moving parts there are to this discussion. And half of those moving parts are future pieces that we don't actually know what they're going to look like. So there's a lot of ifs, ands, or buts, but it can be a fun and interesting conversation. I think at the very least, we need to have it and start preparing for something with the ability to make some adjustments in the future. So I know we have a lot of advisors that are doing Roth conversions, whether it's with us or outside in their managed accounts. We do have some advisors using annuities to handle internal Roth conversions. But I wanted to back up and have a discussion about historical taxes to start out, because while I think everybody sort of knows this, sometimes hearing it in a different way or seeing it in a different way can be very useful. So I'm going to share my screen for just a moment. And this is a piece I created a few years ago that I still like to use. If you've been to one of our events, you might have seen me throw it up on a screen. This is our historical tax rates. So the green line is the lowest tax rates. Yellow is the highest tax rates. And I like the blue line because it's the $100,000 equivalency through time. And of course, we know taxes were created originally that we're going to primarily tax the wealthy, not the regular middle class. Tax rates were pretty low. What I think is important to notice is you can see tax rates spiked for World War I, right? When we have high cost scenarios, taxes go up, and then they came back down. And then the Great Depression, taxes went up. World War II came in, taxes went up. Tom Hegna talks about this on his presentations all the time, right? That infamous question of what's the highest taxes have ever been, and it's 94%, and that's just federal, right? And then of course we see taxes come back down. Where it becomes interesting is when you consider the fact that taxes have always gone up to help cover expenses, and then we look at around 2001. Right, our war on terror after September 11th, that cost a little bit of money, but we didn't raise taxes to cover those costs. In fact, we lowered taxes, quite the opposite. And the red line is national debt. You'll see it take off in a big spike right about that time, right? 2008, stock market crashed. We didn't raise taxes. National debt went up. And fairly recently, we had COVID, where not only did we not raise any taxes to help cover it, we literally printed money for free and gave it away. So national debt's higher than it is there now. But what I like about this is it allows you to look at the history. It allows you to look at national debt. It allows you to take a reasonable assumption to think that we need to raise taxes at some point. I don't know what president's going to get elected by saying they want to raise taxes. But it also lets you see, if you look at the blue line, that $100,000 equivalency hasn't been this low since like 1941. And then you look at the standard deduction being super high. right now is the time you should pay your taxes. Just looking at this. But as I said when we started, there's a lot of moving pieces, and that's one of them. So,
And it doesn't take a lot of foresight to see that this is pretty unsustainable throughout the long term. We're going to have a point where we have to have taxes raised. So if you can get in and take care of that debt now, that's going to be a benefit.
I agree. But Daniel, do you want to pay taxes, or do you want to fund an IRA 401k?
I'd much rather invest in myself than the government.
Yeah. So of course, when the best time to have done Roth, not conversions, but funded a Roth would have been when I was 21, 22, and my lowest income years. But that time's long gone. And for the purposes of this conversation, we're talking about people that are about 60, right? 65. And we are looking at retirement timelines, right? We're going to talk about the time between sort of retiring or cutting back income, going part-time, whatever it may be, and the time of forced RMDs, the time before taking a 4% withdrawal, before claiming Social Security, which isn't taxable on its own, but can become highly taxable if you don't prepare for it properly, right? People used to have pensions. We love talking about pensions because everybody loves that guaranteed income right along with Social Security. The downside to pensions, if you can really talk about being a downside, is it's all taxable money. And we don't know what the future holds for taxes. So we have advisors going after both things here, right? We have advisors that are writing fixed indexed annuities, accumulation focused fixed indexed annuities, and doing internal Roth conversions because they understand the importance of converting money to tax-free money for later in retirement. And then we have a lot of advisors writing lifetime income annuities, right? The guaranteed lifetime withdrawal benefit riders, because you can't outlive those funds. And that brings a little bit of security, predictability, just a little bit, right, to the plan, a little comfort for the retiree. But what people are not doing is they're not doing both. They're not doing it at the same time with the same funds. And really, it's a conversation that we've never really had. So, I know the topic of this is how to properly structure a tax-free retirement. But I think we can all agree that that conversation can be very different based on every single client you've got, their age, their wishes, their money, how their assets are set up, right? So we can't say what you should do is move 20% of their funds into a Roth conversion scenario, right? Because that doesn't work. But we can have conversations for each client if you want to give us a call about it. So for the purposes of this, though, we are going to talk about dollars in conversion. We're going to talk about the consequences of it, the taxation of dollars, and the taxation of Social Security. I think that's probably one of my topics that I enjoy the most because I know how much people love Social Security and they don't love the taxation of Social Security, right? I see all the time that people are complaining about their Social Security being taxed and they say it's double taxed, right? They got taxed on it once and now they're getting taxed again. And we know that's not necessarily true. But so in trying to set up that proper plan, right, properly structuring it, if we are talking about what forces you into a tax bracket, the forcing you into a tax bracket is hitting the standard deduction, right? What if your RMD equals the standard deduction? And if you have 400, well, let's assuming, right? We're going to talk about a client that's 60 years old, and we're going to assume, I guess it doesn't matter the dollar amount for the purpose of this particular part, but if we're growing at a 60-40 split, Daniel, I think that's what we probably hear the most, right? Pretty typical. We talk about what 8% equities, expected returns, 4% fixed income, right? So looking at that growth rate, if you have a client that's 60 now, when they turn 73, 13 years down the road, we are assuming that the standard deduction is going to continue growing at about 2% a year. So keep all of that in mind, right? What the account balance would grow at that rate. If the qualified account balance is $449,000, which isn't much. We get emails all the time from advisors that are talking about portfolio balances and how much they have in qualified and non-qualified. And very few emails do I get that show a client has less than $449,000, right? But $449,000, the RMD at 73 on that value would be what the standard deduction is expected to be 13 years down the road when they're 73. So they're automatically forced, right? Forced into tax brackets. They're automatically forced into paying taxes on Social Security. So I want to have a little bit of a discussion. I'm going to share again. If I can move some screens around. So Daniel and I been talking about the ideal client. So it's probably shared too. The ideal client for this particular scenario. We talked about how much money, should we convert? How much money should you have? And I didn't want to necessarily try to fit a scenario that worked best for us. So we're just kind of running with something. I didn't run a bunch of scenarios to find the best option. So again, a male age 60 or person age 60, let's assume $1 million in qualified assets, no future contributions, just for easy calculation purposes. As we said, 60-40 split, regular growth rate. And they're going to start doing the 4% safe withdrawal rate at age 65. Of course, increasing that 4% a year. We're going to assume claiming Social Security at 70 for $48,000 a year, which is going to be important because then we get to talk about the taxation of Social Security and basic taxes that we look at today, growing at a normal rate of 2%. All right, so if we don't do anything with an annuity, right, I like to compare against a basic plan. So if we assume that that 60-year-old is going to continue growing that account, it would get to about 1.3 million. So the 4% safe withdrawal rate is going to give them $54,000 a year in year one. By age 85, tried to condense down some of my numbers, right? Because I know I can get carried away. The yearly income at age 85 would be almost 100,000, right? So you can see the numbers. The interesting part is the taxable Social Security. You can see it's 85%, right? That's the highest percentage of Social Security that can be taxed, and that's what they fall into with this particular plan. So they're going to pay almost $1 million in taxes by age 100, and they get to take home about $4.5 million, which is not bad considering they started with 1 million. Well, what if we did the Roth conversion? All right, we have annuities with guaranteed lifetime withdrawal benefit riders that allow us to handle Roth conversions each year. Right, we have a way of setting that up, and we can do conversions over a 5-year span. I'm going to pick 5 years, assuming that they didn't have a Roth already set up, right? So we need that 5-year window, and then we're going to do conversions each year. The benefit here is that we're taking advantage of the annuity rates today. All right, Daniel, you've been around a while. The bonuses, the roll-up rates, the payout factors that are available today.
Specifically, the payout factors are significantly higher than we've seen with numerous different carriers, depending on the client circumstances, than they've been in a number of years. So, it's something where you can have the opportunity to get a really strong payout factor that you can go ahead and lock in now.
Yep, we talked about the people that are doing the Roth conversions inside of an accumulation fixed indexed annuity, right? They do 5 years of it, but then what?
Exactly. We don't know
They-
where those payout factors are going to be 5 years from now. And if you're able to lock them in at the current time where they are at historically high rates, that's a great thing to be able to do.
Yep, and you could take the money and put it into a managed account and hit that 4% safe withdrawal rate. But with a lifetime income annuity, we can give you a much higher payout factor, right? And then you don't have to worry about what if it runs out at some point in the future? What if it runs out right as taxes are going up? What if it runs out right as, the husband passes away and leaves the spouse on a single tax bracket and taxes go up? Right? We don't have to worry about any of that stuff. We're providing a guaranteed income that's tax-free forever. So I think I switched slides. So this first one isn't going to make much of a difference. It will do a little bit, and I'll bring it all together in the end so you can kind of see the numbers side by side. But if we did $200,000 to an annuity, and you did $50,000 conversions each year. So by the end of the 4th year, everything's converted. At the 5th year, we are turning on income. All right. So of course we've lowered the account balance. So the income coming out of that with a 4% safe withdrawal rate, which we would probably adjust, but I didn't do it here. The 4% would kick 43,000 a year, and the annuity would kick about 22,000 a year. That's tax free. So your yearly income goes up. Right. We were at what, 50 before? So the yearly income goes up starting out, and taxes go down because a lot of the money is tax free. However, you still have too much taxable money. It doesn't take much, right? We talked about that when we say 400 and some $1,000 would put you over the standard deduction. So we still have too much taxable money because we didn't convert enough. So the taxes on Social Security didn't change. We are decreasing overall taxes, right? We're going down to 800,000. We were at 982. So that's a lot of tax saving. And the net income went up by about $300,000, right? The take home have fun money went up 300,000 because we moved 200,000 to convert over to a Roth. I think that alone is a pretty good story, but what we want is to talk about getting into a 0% tax bracket. Now, obviously, life insurance is a great opportunity for that, but we're going to have an annuity discussion today because I'm the annuity guy. So the next option, I'm going to say is unreasonable because you would never move this much of your client's money into an annuity. So I'm not recommending that, right? I'm simply trying to show some numbers that get us to that 0 that we were looking for. If I think I had more than the 358. Sorry, 358 was what we left in the account balance. Sorry, I messed up my number at the top. So we did $640,000 out of $1 million into an annuity. That's, I mean, we're not breaking 70%, right? But that's a pretty big number. So the account balance on the qualified account at age 65 would be 465,000. 4% withdrawal on that would be 18,600. And because we did such a big annuity, of course, our lifetime income shoots up drastically. So we're going to get $72,000 a year tax-free for life. Now, you don't necessarily need to do that, right? That's where we back up on some of the annuity features. When we first started this, I'm going to back up just to see it, right? Our yearly income started out on day one was $54,000. Now you're going to pay $6,500 in taxes, but we were at 54, and throwing some different numbers together real quick got us up to 90. Maybe you don't need to get to 90. Maybe 54 was okay. Maybe 60, 70 is better. And with this strategy of doing an annuity that has pieces of conversions, you don't have to trigger the entire thing. You could trigger $70,000, $60,000 worth of income and let the rest set. Right? In this particular case, we did roll-ups for 5 years. What if you did roll-ups for 7 years, 10 years, 15 years? Right? Some products do go longer than 10 years. All right. So you could create much more income down the road, much more tax-free, guaranteed lifetime income down the road, if you wanted to. So we're creating much higher income on year one. The taxable and tax-free Social Security, to me, that's the fun part, right? I'm just going to back up one because the first 2 slides were the same when it came to Social Security. At age 85, they were only getting $10,000 of Social Security tax-free. And here we can get $34,000 tax-free. Now, you'll notice in year one, when we triggered income, we were at 0% taxes. We had $0 in taxes due. I want to say, unfortunately, it's not unfortunately, but the 4% withdrawal rate is less than the expected returns coming from the account. So the returns are going to continue going up, or I should say the 4% withdrawal rate growing at 3% outpaces the increase in the standard deduction. Should word that differently. All right, so we're going to end up with taxes. Now, maybe that's where you decrease. Maybe you don't take the full 4%, right? If we're going to get a whole lot more tax-free income, maybe you let the rest of the money set. Maybe we work on very small pieces of other Roth conversions, right? Since we are dealing with the rest being tax-free money, right? Those are all things that we can do. But in the end, we paid $368,000 in taxes, and we got over $5.5 million of net income. Now, I know that's a lot of numbers, so just to put those last 3 on top of each other, you can see the difference in the tax rates as we change the strategies. Very specifically, the amount of taxes paid when we decrease the IRA qualified account balance so that we didn't get forced into paying so many taxes. Look at the difference of taxable Social Security.
It's a pretty massive difference when you look at that.
Yep. So not only are we not taxing the income that they're getting every year, all right, think about the savings there. But if we're also not taxing the Social Security as drastically, if you bring that into their effective tax rate, I mean, I think up top we were looking at an effective tax rate of 17% starting out, and down below we were down to 0 and 1 and 2. It's a big difference. Now, most of you guys know that because you're already doing it, right? You're already doing Roth conversions. You know the importance of doing it. I think the value here is more of, I'm gonna stop sharing the screen. You guys can reach out if you have any questions about that. I think the value and importance here is the fact that we can, as we said, take advantage of annuity rates today. Right? If you've been doing this long enough, you know what the rates used to be several years ago. You know what the lifetime income rates used to be. We replace so many old lifetime income annuities, right? Because the rates are so much better these days. I replaced one for my mother a couple of years ago. It had just been written. It was written with good rates. And like 2 years later, we were able to replace it and give her guaranteed increasing income for life that started out higher than her level income was. And that was after paying like 8% surrender charges, which is insane to pay, right? But the income, it made sense. And we can take advantage of those rates today with future Roth conversion dollars.
One thing I did want to ask you about, Doug, if, we get into scenarios where we set everything up in the perfect way, but then life happens, right? What happens if one of the spouses passes away? Do we have kind of the way that impacts these scenarios? What do these annuities look like, as far as the income goes in a situation like that?
Yep. So depending on the annuity, depending on the product, right? So some products, if a person passes away before income starts, you can convert it over to single income instead of joint income and get a higher payout. Some products are annuitant driven, and if you're dealing with qualified money, if the joint annuitant, the spouse passes away, they're not the owner of the money. If they pass away, it's still a death on the contract. It's a death of an annuitant, and the contract is annuitant driven, which means surrender charges could be waived. Right? So the owner of the money, if they wanted to, could take the money and run. I don't think that's probably in their best interest. But knowing that that's available, at least as a feature, is nice. Kind of like, I looked at it like those old school chronic illness riders. I don't know if they still exist on life policies, right? Where you didn't pay for it. It's not very good, but hey, it's there, right? So
or kind of a hedge against, a scenario where payout factors increase even further, right? If it's a scenario like you were discussing with your mom, if you have that death benefit, then you could use that as a bailout in a situation like that and maybe opt into something even higher down the road.
Yeah. Or maybe they want to pull some of the money out because now they can switch to a single income and it's more than they really need, especially by themselves. So they can pull a little bit of it out penalty free and put that into a managed account. Right? There's all kinds of fun options. And we didn't talk about any specific products here because I didn't really want to lock us into a carrier or product. It's more strategy, idea, concept. And these products and the rates change all the time. So this is all just conceptual, but it does work. Any other thoughts to run with on that? I think we touched on all the topics and ideas that we wanted to. Any questions from anybody? No? All right. Well,
here's one. Steve Walker asked, Doug, in your mind, is there an age too young or too old to consider this strategy?
To consider this strategy. So it's not even just Roth conversions, it's this strategy.
Well, or just Roth conversions in general, I think.
Well, I would say
Roth conversions or both.
Okay. So obviously Roth conversions itself is much better as people are younger, as we talked about. They're in their lowest taxable years. As they get older, they're going to make more money. No one ever wants to do Roth conversions as they get older because they're in their highest earning years ever, right? But like, I look at myself and I could say that, but I've got another 20 years to go. So am I really in my highest earning years ever? Maybe so far, but not ever. But of course, the younger, the better to contribute to a Roth. As far as too old to do it, I think once you get further penalties from it, the whole point of being able to do Roth conversions is to get the tax-free money. So if you're going to start doing Roth conversions after you've claimed Social Security, you're just going to further tax your Social Security. It might not be worth it. If you're going to try to do it after age 73, right? When you're facing RMDs, right? That's going to all depend on the client. For buying the annuity, I think once you get beyond 10 or 15 years before retirement, you don't have as many good options in an annuity for that long-term roll-up. I'm not saying it doesn't exist. I'm just saying it might not be quite as good of an option. So we would want to look at that on kind of a case-by-case basis. Did that answer that part?
Yeah, we had another question from Phil. Phil Hogue saying, are you seeing any blended strategies or partial conversions to Roth and leaving some of the tax qualified? I think maybe speak to some of the solutions that are available there and, you know, the internal conversion process.
I think for us with annuities, when we're looking at advisors using annuities for Roth conversions, their intention is to do all of it. They're not using all of the qualified money, obviously. They have predetermined what they want to ultimately convert to Roth, and then they'll fund an annuity, right, as an IRA. And then each year they just convert a piece of it to Roth. And by the end of it, they'll have converted all of it. I don't know that I've seen that strategy in place long enough to say whether they end up doing that, right? Do they get to the end of the 5th year and have they converted all of it over? I don't know. I think I've only been seeing that for maybe 3 years or so now.
And one thing to maybe mention is that, you know, with these, it's not multiple applications in order to process that. We can do that, you know, all on a single ticket and set it up at the initial purchase. You know, obviously there's some paperwork involved in the conversion itself, but you're not talking about an entirely new application process where you're having to resell the client on it every time you're doing that.
Yeah. And you're not writing it in stone.
Correct.
Right? You're putting a plan together. You want to convert X dollars each year, but you know, as you said, life happens. Things happen. Maybe 2 years down the road, something drastic changes, and you don't want to do a Roth conversion that year, right? Maybe it's a business owner that sells their company, and or they I don't know, get a big ticket item that brings in a lot of income, and all of a sudden you don't want to do Roth conversions. But it does still leave that flexibility.
So this is a little out in left field, but can we do that with a mega, you know, a backdoor Roth conversion?
With a MIGA,
Yeah. Because there's new limit, you know, the Secure Act gave you new limits to that, right? I mean,
yeah.
I can't remember what it is, 70,000 or whatever it is. Can you do that? Can you use that?
You could, I mean, I'd have to check.
Okay.
You know, that it's a day one Roth conversion, right? It's an immediate fund and day one Roth conversion of the entire amount. So
Yeah,
I
good
would
question.
think we could probably do that.
Because I think at least the plan we're on, I think allows that. I mean, it allows the back door depending on your income and all that.
Yeah, I think so. Maybe give me a call afterwards and let me reach out to some carriers and kind of see what they say. I would have
Okay.
to imagine that we've got at least a couple that would say yes to it.
Okay.
Anything else?
One last thing Phil mentioned is one major overlooked discussion around this is the Secure Act 2.0 and beneficiaries having to pay tax over 10 years, taking qualified money at their highest earning years. So if client wants to avoid the tax lien on the kid's inheritance and aren't insurable, Roth conversions work great in that scenario.
Yep. Pass on tax-free money.
Absolutely.
It's not quite as good as leveraging the life insurance, but like you said, if they're not insurable,
Absolutely.
right, look for an option that works.
Exactly.
Okay. Thank you all for joining us today. Next month, our third Thursday at 3 will be held on March 19th, and we're going to be diving inside Stream, a smarter premium finance approach. Tax-free retirement income using other people's money. Not too good to be true. And this live workshop will show you how. Join Richard DeSantis, the Director of Internal Sales at Stream, for a deep dive into Stream, a unique no collateral premium finance strategy that helps high earning clients build significant pools of tax-free income through leveraged life insurance. Again, thank you all for joining us. And if you have any questions or want to learn more, contact your RVP or myself. Thank you.